Okay, so you want to own a commercial real estate empire. Strip malls, small shopping plazas, maybe a standalone retail building on a busy corner. Businesses pay you rent, they pay for their own repairs, they even cover your property taxes, and you just cash the check every month while your buildings quietly go up in value. That's the pitch. And on paper, it's the cleanest version of real estate investing there is. Here's the part nobody puts in the pitch deck. Most first-time commercial buyers get one property, watch it sit half empty for 18 months, and realize they've been carrying a six-figure mortgage on a building that generates almost nothing. The operators who actually build empires out of this aren't the ones who bought the flashiest plaza. They're the ones who understood, before they signed anything, that a commercial building isn't really a rent collector. It's a bet on a tenant's business surviving, and you only get paid if theirs works. By the end of this video, you'll know what it actually costs to buy your first commercial property, how the lease structures that make this business famous actually work, what silently eats the returns that landlords assume are guaranteed, one of the most famous real deals in commercial real estate history, and what it teaches you, two full scenarios with real math, and why this business rewards patience more than almost any other asset class, and punishes impatience harder than almost any other too. So what does it actually cost to get in? Commercial real estate doesn't have a starter home the way residential does. The cheapest realistic entry point, a small, unanchored strip center with 4 to 6 retail bays in a secondary market, typically runs from around $700,000 up into the low millions, depending heavily on location and tenant mix. Lenders generally want 20 to 30% down on commercial acquisitions, so on a $1 million property, you're looking at $200,000 to $300,000 in cash just for the down payment. Add closing costs, which run roughly 2 to 4% on commercial deals. Call it $20,000 to $40,000, plus a Phase 1 environmental assessment, which commercial lenders almost always require, and which typically costs $2,000 to $6,000. Then there's the number nobody budgets for: tenant improvement allowances. If you inherit vacant bays or a tenant leaves and you need to release the space, landlords routinely have to contribute $20 to $60 per square foot to build out the interior for the new tenant's needs. On a 1,500 square foot bay, that's $30,000 to $90,000 you may need to spend before that space earns you a single dollar. Stack it up. A first commercial property, bought conservatively, with one vacant bay you need to fill, you can easily cost $260,000 to $450,000 in cash before you've collected your first rent check. That's your entry fee. And that's for one building. An actual portfolio, the kind that produces real income, usually means 3 to 6 properties, which means most operators either bring in outside investors through a syndication, or they use the profit and refinanced equity from property 1 to fund property 2, and so on. Very few people buy a commercial empire in cash, one deal at a time, out of pocket. Now here's how the money is supposed to work. In one line, tenants pay rent, plus most of the building's operating costs, and what's left after your mortgage is your cash flow. The structure that makes this different from residential is called a triple net lease, NNN for short. Under NNN, the tenant doesn't just pay rent. They also pay a prorated share of property taxes, building insurance, and common area maintenance, the parking lot, the shared lighting, the landscaping. That's the appeal people talk about. Your tenant is covering the very expenses that eat a residential landlord alive. But here's the counterintuitive part almost nobody explains going in. That arrangement only protects you while the space is occupied. The moment a tenant leaves, every one of those costs, taxes, insurance, common area upkeep, snaps right back onto you, the owner, with zero rent coming in to offset it. Let's run the numbers on that $1 million, 6-bay strip center. Say it generates $95,000 a year in gross rent when fully leased at a market cap rate of roughly 7%. Your mortgage on $750,000 borrowed at a realistic commercial rate around 7%, amortized over 20 years, runs close to $70,000 a year in debt service. That leaves $25,000 before you account for the one bay you had to renovate to release, and before you account for the months it sat empty while you found that tenant. Commercial vacancy periods run longer than residential, Often 3 to 9 months for a small retail bay, sometimes longer in a soft market. Lose one tenant for 6 months, and you've likely wiped out that entire year's cash flow, maybe gone negative. This is where new commercial buyers panic, thinking they bought a dud. What they're missing is that, same as in any leveraged real estate, they're also getting equity paydown from every paying tenant and appreciation on the underlying asset if the surrounding market grows. But unlike a house, a commercial building's value isn't really about the building, it's a direct multiple of its net operating income. Raise the rent roll, the value goes up. Lose a tenant, the value drops, sometimes sharply, because you're valuing income, not bricks. Smart commercial buyers don't buy a plaza because they like the corner. They buy because the in-place leases, the tenant mix, and the remaining lease terms pencil out to a number they've already decided they need, and they walk from almost everything else. So what's the bleed nobody mentions? Three things quietly separate the operators who make money from the ones who don't. First, lease rollover risk. Commercial leases run 3 to 10 years, which sounds stable, but it means income isn't guaranteed the way people assume. When several leases expire around the same time, called rollover risk, you can face simultaneous vacancies, simultaneous releasing costs, and simultaneous broker commissions, which typically run 4 to 6% of the total lease value paid to whoever brings you the new tenant. Second, tenant quality and personal guarantees. A national chain tenant is bankable. A local small business, the kind that actually fills most small strip centers, closes at a meaningfully higher rate, especially in the first 2 years. And when a small operator's business fails, you're often left chasing a broken personal guarantee that's barely worth the paper it's printed on. Third, and this is the one that quietly kills portfolios, capital expenditures on commercial buildings are bigger and less predictable than on a house. A single roof replacement on a 15,000 square foot retail building can run $80,000 to $150,000. Resurfacing and restriping, a parking lot runs $10,000 to $40,000 depending on size. An HVAC replacement across multiple bays, especially rooftop package units, can run $8,000 to $15,000 per unit, and a 6-bay center might have 6 separate systems. None of this is optional, and almost none of it is covered by triple net reimbursements, because major structural capital expenditures are typically the landlord's responsibility, not the tenant's, even under NNN. So who's actually built something real out of this? One of the most instructive examples in commercial real estate isn't a small operator, it's Sam Zell, the man who effectively invented the modern office REIT, and it's worth understanding both how he built it and how he got out, because the exit is where the real lesson is. Zell spent decades assembling office and commercial properties into what became Equity Office Properties Trust, at one point the largest office landlord in the country. He took it public in the 1990s using a REIT structure that let him convert illiquid buildings into a liquid, income-distributing stock. By the mid-2000s, Equity Office controlled a massive national office portfolio. Then, in February 2007, something happened that looked, on the surface, like the deal of a lifetime for the buyer, not the seller. Zell sold the entire company to Blackstone for $39 billion, engineering a bidding war against a competing buyer that pushed Blackstone roughly $3 billion above what it originally intended to pay. Blackstone financed the purchase with around $32 billion in debt, the largest real estate financing in history at the time. 2 days before the deal closed, a British bank quietly disclosed losses tied to subprime mortgages, the first public tremor of what would become the 2008 financial crisis. Within 18 months, credit markets seized, real estate values across the country dropped sharply, and Blackstone's newly acquired assets were, by some estimates, written down to roughly 65 cents on the dollar. Zell had sold at the literal top days before the ground shifted, while the buyer was left holding record leverage into the worst real estate downturn in a generation. Zell has said publicly he wasn't trying to time the crash. He simply received what he called an offer he couldn't refuse and took it. But the mechanics of why it worked out so well for him, and so brutally for the debt-heavy buyer at first, map exactly onto everything already covered here. Income-producing real estate is a bet on the strength of underlying leases and available credit, and the moment either one turns, leveraged owners feel it first and hardest. Blackstone eventually turned the deal profitable by selling off pieces of the portfolio over the following years, but only after riding out a downturn that could have sunk a less capitalized buyer entirely. Which brings up the actual failure pattern in this business, because it isn't usually one bad tenant. It's leverage stacked on top of concentrated risk with no reserve. An operator buys 2 or 3 commercial properties in a hot market, using close to maximum leverage to preserve cash for the next deal. The properties are cash flow thin from day one because they were bought at a low cap rate in a competitive market. Then one anchor tenant leaves, or interest rates rise and a loan comes up for refinancing at a dramatically higher rate. Commercial loans typically carry 5 to 10-year terms with a balloon payment, not 30-year fixed terms like a house. So refinancing risk is baked into the business in a way residential investors rarely face. Suddenly, the debt service on refinance exceeds what the rent roll can support. The owner is short every month, reserves run out, and the lender moves toward foreclosure, often triggering personal guarantee clauses across the operator's other properties at the same time. This exact pattern hit thousands of commercial owners after 2008 and a smaller but real group again in 2023 and 2024, when commercial loans written at 3 to 4% during the low-rate years came up for refinancing into a 7 to 8% environment almost overnight. The owners who survived both periods weren't the ones who avoided debt. This is a leveraged business by design. They were the ones who never let a single tenant or a single refinancing date represent more than a small slice of their total portfolio income. So let's put real numbers to 2 paths. Scenario 1, the small operator. You buy one $1 million strip center, 20% down, so $200,000 in cash, plus roughly $30,000 in closing costs and reserves. Call it $230,000 in. Fully leased at $95,000 a year in gross rent, mortgage at $70,000 a year, and NNN reimbursements largely offsetting taxes and insurance while occupied. In a clean year with no vacancy, that nets you around $18,000 to $22,000 in actual cash flow after debt service and a management reserve. That's real, but modest, roughly $1,600 a month for owning a building outright. Now add the layers residential investors get too. Principal paydown of roughly $12,000 to $15,000 a year on that mortgage, funded entirely by tenant rent, plus appreciation. If net operating income grows, a strip center that raises its rent roll by even 3% a year can see its value climb by tens of thousands of dollars annually, since commercial value is a direct multiple of income. Over 10 years, even conservatively, that single property can realistically move from $230,000 of invested cash to $500,000 to $650,000 in built-up equity, a 2 to 3 times return, mostly earned through debt paydown and rent growth rather than flashy cash flow. Scenario 2, the realistic, unglamorous version. Same $1 million center, same financing, except in year 3, your largest tenant occupying 40% of the leasable space doesn't renew. It takes 7 months to release the space, during which you're still paying full debt service, taxes, and insurance with almost no rent coming in. Releasing costs you a $35,000 tenant improvement allowance and a $4,000 broker commission. That single vacancy event costs you an estimated $55,000 to $65,000 in lost rent and out-of-pocket expenses, more than double what the entire property was expected to net you that year. From the outside, nothing about the building looks different. The sign is still up, the parking lot is still full most of the time. The other tenants are paying like normal. But that one empty bay just erased 2 to 3 years of projected cash flow, and if your reserves weren't built for it, you're now funding a commercial mortgage out of your own pocket while you wait for a new tenant to sign. There's one more angle worth knowing before you go looking at listings: mixed-use conversion. Some of the strongest returns in this space over the last several years haven't come from buying and holding a plaza as is. They've come from buying an underperforming retail center in a growing area and converting a portion of it, adding restaurant pad sites, medical or fitness tenants, or even residential units above retail, which typically command materially higher rent per square foot than traditional small retail. The trade-off is obvious. That requires construction expertise, zoning approval, and patience measured in years, not months. It's a development skill layered on top of a landlord skill, and most first-time buyers aren't ready for both at once. Zoom out, and the historical pattern here rhymes with every real estate cycle. Buyers who acquired commercial property between 2010 and 2021, when interest rates sat near historic lows and retail was considered a dying asset class and bought cheap and financed cheap. Many of those properties have since re-rated sharply higher, as retail proved far more resilient than anyone expected. Buyers who bought at the top of the market in 2021 and 2022, financing at low fixed short-term rates that are now coming due for refinancing, are the ones facing the squeeze today. The lesson isn't that commercial real estate stopped working. It's that in a leveraged, lease-dependent business, timing your financing structure matters almost as much as timing the purchase itself. So here's the honest answer. Can you build a real commercial real estate empire? Yes, and the ownership records of nearly every small city in the country are full of people who did it quietly over 20 or 30 years. But it rewards patience and punishes leverage taken without reserves, because in the end, you were never really collecting rent from a building. You were always just borrowing the financial health of whoever signed the lease, and the whole business only works for as long as they keep showing up. Next time, it might be worth asking what happens when landlords stop renting to businesses altogether and start renting the land itself, because ground leases run on a completely different set of rules, and almost nobody understands them until they're already in one. If you want to see the ground lease breakdown, or the deeper dive on how tenant improvement negotiations actually work in practice, drop a comment and let me know which one you'd rather see first. And if this kind of breakdown is useful, subscribing means you won't miss it when it goes up.